we are now touching the essence of the DuPont formula. And we were talking about return on equity, how fantastic tool is that. Obviously, we have again this weighted average issue, because as in the case of assets as well, equity is something that we take from the balance sheet. So again, there might be a difficulty in judging how good the managers were if we take just the one of the year and day. So maybe we should sort of make this weighted average of the year, like average beginning the end, or like month by month. It depending how we want to make the analysis of this company. So again, when we use this equity as a average, then we sort of make it more like period-wise thinking. So it's just for you that sometimes it might happen. Obviously, it will be written in the analysis, and obviously it will be mentioned, or if you do it, you will mention this. Some concluding remarks about return on equity, because we just did not talk too much about that, but it's a wonderful weapon in financial analysis. It's a fantastic tool, because it really relates net profit to something that owners, investors put into the company, and then we could find this shareholder equity in the balance sheet. Again, it's fantastic to compare between different companies, but still they have to be similar, because in certain businesses, in certain years, there should be some common things. You know, if the company is in steel business and the whole steel business goes up, then it should be like in industry, some kind of higher numbers. If there are difficulties, then in agriculture business, for example, it's the same. There are some businesses that would show these similarities. And of course, the higher, the better. Sometimes it might happen that some businesses have very high return on equity because in general they do not need too much of assets. If they depend very much on like idea, thought, manual work and so on, then, or even intellectual work like designing computer games, then obviously return on equity should be very high. In other businesses, when you need to build a construction, some kind of premises, then it might be lower. So always remember, the same industry. And now, who knows Warren Buffett? Warren Buffett is some kind of the most important people in investment. And then he said something like this: the best business to own is one that over an extended period can employ a large amount of incremental capital at very high rates of return. The worst businesses to own is one that must or will do the opposite, that it's consistently employ ever greater amounts of capital at very low rates of return. Unfortunately, the first type of business is very hard to find. Berkshire Hathaway is his investment fund. Yeah, that's the whole point. The investors want the company, when you have some amount of equity, the managers sort of give a high return on that, and then with the retained profit, they accumulate, and it goes within the company, somehow like this, right? The worst situation is when investors must all the time add money, and then these returns are still very slim. Fine. DuPont Formula. We are there. the holy grail of financial analysis, in my opinion. In many books, it's sort of neglected, or I think, because I'm a practitioner a lot, it's fantastic, just great. So, DuPont analysis, or DuPont pyramid, or DuPont formula, that's a couple of names, but still DuPont. And there is a saying, because this is a chemical giant, and they invented nylon, they invented lycra, Teflon, Kevlar, plenty of things that are wonderful inventions. Still, in financial science, they gave one of the most powerful tools, like return on investment. Return on investment in a meaning of proprietary first investment into the company. Like in our nowadays saying is equity. Generally, they sort of masterminded in DuPont return on equity. I have put here the whole story because I think it's wonderful, this story of Mr. Donaldson Brown, who already in 1912, he invented this idea of splitting generally, of decomposing DuPont Formula, or rather return on equity in DuPont Formula. And he had this idea that it could be found something in this simple tool like return on equity, something more than that we could judge the company. We will see it. So before this invention, businesses were run in a very simple way. You produce something, you sell something, you have some money, then you open a drawer. If you have some money, it's okay. If you don't, it's bad. It's simple as this. Nobody thought about any profitability, rentability, costs, and something like that. So they in DuPont, they thought, no, we have to, in our corporation, to see it more closely. And they invented the role of chief financial officer, because previously there was nobody like that. They were like owner, some salesmen, some people for production, but for financing? No. So they are revolutionary in this sense. So Mr. Brown made it before buying some stake in General Motors by DuPont, and then he moved to General Motors, and then the whole idea spread gradually all over the United States to become in 1950s really a leading technique in assessment of businesses, of rentability and profitability of businesses. So, what's going on? So, return on sales, return on assets, and return on equity, their appeal lies mainly that it's like single, intuitive measure, easy to understand, in a ratio format, easy to use. But as well, there must be some adverse effects of this simplicity. Because if we measure only that, and we have only these measures in mind, there is no incentive, for example, for research and development spending. So, because if they want to move up the figures on return, like return on assets or return on equity in particular, then they would not spend anything for future development of the company. So we have to be very cautious in looking on how they behave, if this short-term action does not make harm in long term of the company. Still, we have to be really admiring this DuPont company, because they usually give quarterly dividends, and the string of giving this quarterly dividends, unbroken string, goes back to 1904. So really they know what they're doing in their company. The introduction ended. Now we have what is all about. So we need some decomposition, and we will do this decomposition in, I believe, 6 parts. Again, step by step. You know, in the end, it will prove to be quite easy, but we have to be sure, absolutely sure, that we understand each step. So we start in part 1 with a reminder. What is return on sales? Return on sales, you know it, net profit divided by sales. Fine. We already know this. So now we jump straight to the part 2, and now the magic starts to appear. Because look, when we have return on assets, it's equal net profit divided by assets. So, mathematically, we could spot that it's net profit divided by sales multiplied by sales divided by assets. There is nothing extraordinary in what we have done in the sense of mathematics, but it's a giant leap on the moon in science of financial management. Because now we split return on assets into return on sales multiplied by this expression sales by assets, what is called, what we have done, return on assets is equal return on sales multiplied by asset turnover. This is interesting. This is hugely interesting. We have a new expression, asset turnover, sales divided by assets. So now we jump to part 3, and we'll start to analyze what it is. Asset turnover. The asset turnover ratio is an efficiency ratio that measures a company's ability to generate sales from its assets. Okay? How many sales from how many assets? By comparing net sales with total assets. In other words, this ratio shows how efficiently a company can use its assets to generate sales. Assets to generate sales. This is interesting. The total asset turnover ratio calculates net sales as a percentage of assets to show how many sales are generated from each dollar of company assets. For instance, when we have the asset turnover ratio 0.5, means that each $1 of assets generates 50 cents of sales. Clear? Perfectly clear. Now, we have this formula to be sure that we know it. Asset turnover ratio is calculated by dividing net sales by average total assets. The formula, asset turnover equals sales divided by assets. There are some comments, as usual. Either there is variation, or there is a comment, or there is a caution, always something. So we have some comments. Because the sales, obviously that all, but if we think about using our assets, they should be in form of net without items returned. And then, because if we add them, it sort of makes our judgment not clear. And as well, there are some businesses that have a lot of items returned. Because what we really need, we need to focus on the ability of the company to generate sales from the assets, true sales, true. And obviously this is all to be found in profit and loss account. And as usual, higher ratio is always more favorable. Because when we have higher turnover ratios, it means that these assets of this company are used efficiently. If there is a low number consecutively, we might think that the company has a lot of assets, but they are sort of idle, or they are not efficiently used, or there's something in management of large properties or in production that something is wrong. These assets are not properly used. For instance, if the ratio is 1, it means that net sales of a company equal average total assets for the year. In other sort of words, company is generating $1 of sales for every dollar invested in assets. And, of course, as usually in this kind of analysis, we have to underline that asset turnover ratio is a spectacular tool. But we know that assets, already it was mentioned several times, are used differently in different industries. So we should always, in this respect always, to compare companies from the same industry. Because industries, businesses, groups, places, they have a similar, they tend to have similar asset turnover ratios. And again, because it's such a clear formula, while analyzing a company, we should do it like on a yearly basis from one year to another to establish if this asset turnover ratio shows a proper management of the company. Again, variations, you might say, variations. Yeah, because asset turnover ratio is a great general efficiency ratio, and it shows how well a company uses assets. And obviously this gives all participants, like investors, creditors, an idea how the company is managed and how these assets are used in generation of sales. But of course there are some variations. Variations are not too complicated, and I'm just mentioning them, that sometimes investors or creditors or analysts, they would like to know how specific assets are used in generation of sales, like for example fixed assets, because some companies in some industries, they might have very large fixed assets. So how these fixed assets are used in generation of sales. Or on the other hand, for example, in this particular industry, current assets are the most important. So analysts would like to know what's about current assets. And so the fixed asset turnover ratio and the working capital ratio, they are similar and they give similar information, but they give it on basis on specific asset classes. Now, part 4 of our fantastic DuPont formula. Now we come to return on equity, this magic tool. And we are now able to decompose return on equity into various factors and find what really influence this most important return on equity. Look, return on equity is net profit divided by equity, what equals net profit divided by assets multiplied by assets divided by equity. Mathematically, again, it's such a simple, just almost funny thing to do. But economically, it's a genial invention. Because now we have return on equity equal return on assets multiplied by equity multiplier or multiplicator. Multiplier perhaps sounds better. Return on assets times equity multiplier. So probably now we will concentrate on the factor what makes return on equity higher. So if we improve return on assets, it will be higher. If we improve equity multiplier, it will be higher as well. So let's have a deep look. So this equity multiplier, we have the formula, is assets divided by equity. So now we know it's all about equity and debt. How revolutionary is that? So companies finance the purchase of assets either through equity or debt. So a higher equity multiplier indicates that a larger portion of assets financing is being done through debt. Because of our knowledge of accountancy, we know that we could describe equity multiplier as assets divided by equity, what in fact is equivalent of equity plus debt divided by equity. I put it just to make our imagination work. Because if we have no debt, effectively, we have no equity multiplier. We run on our own money. In fact, because all assets will be our equity. Will be coming from our equity, to be quite precise. So now we have this decomposition in full, this sort of decomposition in full. Return on equity is equal return on sales multiplied by asset turnover multiplied by equity multiplier. Any conclusions from that? How could we influence return on equity? This is the part 6 of our DuPont formula. Final step. Final step is that. How we influence return on equity? If we have high return on sales, as high as possible asset turnover, and as high as possible equity multiplier. And if ROE is return on sales multiplied by asset turnover multiplied by equity multiplier, and if ROE is the most important measure of a company performance, it means that to company's advantage in this situation, when every one of these three as the highest level possible to manage, okay? It has to be as high as possible. Then if return on equity, which is return on sales multiplied by asset turnover multiplied by equity multiplier, it means that in order to improve the company's return on equity, the management should monitor all of these ratios and concentrate on this one, which is currently possible to move up. This is all about that. One thing when we return to this here, this concept of equity multiplier is that we put our own money into the company, it has equity as our own money, and then because hopefully it's running smoothly and is making profit and is sort of having better rentability than interest rates, because it's the whole sense of that, then the company could incur some debts. And if it's done wisely, with caution, but as well with some kind of expansion, that the debt is incurred, and then of course it's operated well with interest paid and so on, then it makes our return on equity really high. Because based on our equity, we make the company grow, incur debt, and then so the cost of debt is the interest, but our profitability of the whole company is higher, so our return on equity is even higher. Brilliant concept. We should do it. Of course, we cannot do it in infinity, because if there's too much debt, there's too many risks, because we could be finally in a position when we are not able to pay interest and then principal, so it's even worse. So this is the final decomposed DuPont formula. This is like this: return on equity equal return on sales multiplied asset turnover multiplied equity multiplier. And then there is some kind of, I would say, supplements in this thinking, because I mentioned how important might be using average figures for two consecutive periods instead of one, like only one figure. So this weighted average of assets or weighted average of equity. And we will have a look right now in some kind of tables, briefly. You could study it later. I will just point some things. Then we have the company that is running sort of in a stable way, I would say, quite a stable way, because total assets are sort of growing to 2012. Suddenly it's going down. Maybe there was a sale, or then purchase again, and then it's going up. Debt is as well swinging, because it was really huge in 2012. Maybe something was sold to cover the debt, so then the debt really went down and then again up. Equity is sort of going steadily. It had to be added in 2013, maybe as a result of sort of debt being repaid. The business went up very nicely till 2012 to 9,000, but then it dropped, but then again it recovered 2015 very well. The only thing I should say in the first column should be 2010, just to make it straight. Okay, and then we have the calculations of return on sales, return on assets, and return on equity in percents. And we could see that for 3 years to 2012, this return on equity, return on sales was sort of pretty flat, but still very high. But then because of our structures, like we incurred a lot of debt, our return on equity was fantastic, 90%, just incredible. But then 2013 it crashed, right? It's 4.8 only, but then it's sort of going up and down. And then below we have asset turnover and equity multiplier. They are not in percentage, they are in figures, in numbers. We cannot confuse that. And then we have a calculation like that. Please have a look. We have the calculations when we use averages. And we have these averages as well. In the first column it should be 2010, because then the average is 2010, 2008, right? So before. And when we have these average figures, they are in italics, So the figure sort of bent. Of course, revenues and of course costs are not averaged because they are for the period. But then we have different figures. Look, for example, at the column 2013 and the average 2013-2012. What happens is if we use this average figure, because when we use the end period figure 2013, we see return on assets is 4.5, return on equity 4.8. But suddenly, when we use average figures, return on assets is as low as 2.9%, and return on equity is suddenly higher, 6.3. You know, when the figures are sort of really high, really huge, maybe it does not matter so much. But if they are really real figures from real world, and they are in some industries well below 10%, in many agricultural businesses, food processing businesses, it's sort of 3% maybe return on assets, something maybe 4%. So return on equity is even in the same area. So it may mean a lot when we compare companies. Just to make you really your imagination sort of blow, I would put the differences in percentages of the figures at the bottom, and then you see how it varies. Like equity multiplier for 2013 was like 1.1, but if we take the average figures effectively, it was much bigger because it was 2.1, like twice as big, because they are normal figures, they are not percentages. So this is the supplement to make you aware about averages. And now we have the supplement 2. There is something interesting, and I would like you to study this issue. If return on sales is return divided by sales, if return on assets is retained by, you know this decomposition. So finally, we have this return on equity is return divided by equity, means return on sales, multiplied asset turnover, multiplied equity multiplier. But if we have something like this, return on omega, and it's return on omega, and then at the end we have multiplied equity divided by omega, right? So what is omega? Anybody could give me the answer? It's a very tricky, I would say, a question. Reminder, this is the DuPont formula. What is return on equity decomposed in 3 parts that all of them have their particular economic meaning. It is measurable and it has meaning, really in sense of economics. So, as I said, I strongly believe in ratio analysis, but as well, there is a number of limitations or comments or conclusions. So, firstly, if the data from financial accounting, from financial statement is incorrect, the whole analysis will be incorrect. As simple as that. So we have to trust the accounting information. Like we are investors, so it's like publicly made information, or we take information from our accountants. We have to trust them, that it's properly done, and then our analysis could be reliable. Then, because if the data is done by accountant and still, for example, not audited, it as well could be some misinterpretation of ratio analysis. I warned you once that a single ratio does not give the whole picture. There must be a couple of ratios from different perspectives, from different groups to analyze the company. Because a single ratio, okay, gives a first glance, but not will be the answer if this investment is a good one or not, if we are investors. And then there's one important thing that we mentioned sort of slightly, that we use this analysis in consecutive years from the past. So as such, we deal only with historical data. We just do not touch future at all. We don't say about expectations, forecasts. Of course, you could do the analysis of the forecasts as well, of course, but they are only forecasts, only predictions. So what we do is the historical analysis, historical data. And if we do the future predictions, it's based on the past performance. And we never know if the past performance was the good one enough for the future, or maybe it was exceptional, it will never be again like this. You never know. You have to use your own thinking in interpretation. Again, if we do like long-term analysis and we have some trends, if there are strong variations of the price level of certain goods and products, this is, for example, like in copper mining industry. They dig copper normally, substantially, all the time. Like they have the assets, they have the copper mine, and they dig it, they sell it. There is a demand, but price of copper goes up and down. So as well, the rentability ratios, for example, they will be all different and possibly distorted. It's again very important to underline that if we compare year after year in one company, we have to know that the accounting principles and policies are the same. As well, if you compare the data from different companies, you must be sure that their accounting principles, policies, laws, regulations are the same. Because if you do not do it, then the comparison is not clear. And this is very important. When we do this analysis of ratios, we never know if there was a special event, special catastrophe, or special winning, or special insurance be paid. Plenty of things like that. There is as well leasing that is off balance sheet. There's plenty of things that you have to put into full analysis of the company. As I mentioned, the copper industry, when you do the ratio analysis of a certain company within certain industry, then it's very useful to have the knowledge about this particular industry, how it operates, what is important. Maybe they have sometimes much longer periods than 1 year of investment, of return. And you have to be an expert. I mean, if you give the ratio to somebody who does not understand this, but you are the experts, you are outstanding students. So brief summary of what we have done with ratios. Brief, just in a bullet. That ratio analysis is an activity that uses financial information to help managers to run the company. Yes, these are the indications. These are just some figures, just some numbers. And when you know how to interpret them, you know basically how to run the company. And because we use the data from the financial statements, and we use basically balance sheet and profit and loss account, and we know that the balance sheet is a proper picture of the company, like a photograph, but only on one point of time, on a yearly basis, the most likely. So we have to remember again that something might have happened in between these dates. Quite a lot of things happen. But we have to judge which of them are normal operating business of the company and which of them are exceptional. And as such, we have to treat them exceptionally to take it in account how we interpret ratios. But if we, on sort of daily basis, daily maybe not, but sort of on regular basis, we are analysts, say, in an investment company, and we, on current basis, we analyze companies, and many companies, many companies, even from the same industry. It's a wonderful tool to effectively analyze and quickly analyze companies, because you just do the number and then you know how to interpret the number. And again, as we noticed, we mentioned there's variations of the ratios and weighted average concept of ratios, that we have to be sure that we prudently use them in consistent way according to the industry and according to businesses. You really need to know when to use the weighted average and when not, or if you have the subtleties in variations, why you use certain variation, what for. And the final word is that, when you analyze the company, we use just balance sheet and the profit and loss account. But there may be many other things, like investing in new areas, new businesses, new countries, changes in management, changes in ownership, technological changes of the product. We have to analyze everything else as well. Overall economic analysis of the company and of the industry.